Today, I have a message, but it is specifically for those who are new to the investing world. We all know how complicated investing or starting investing can seem. But if you are new to the investing world, here are 8 critical investing mistakes that you should avoid at all costs. The first one is lack of patience. Most people, when they think about investing, they think that when they put money today, they will have a profit the next day. But that's not how the investing world is. So if you want to succeed, you must make sure that you are extremely patient. Otherwise, if you think it is a get rich quick scheme, then you are better off to look for something else. But otherwise, if you want to grow your money from the investing point of view, you must be willing to be as patient as possible. And that takes me to number 2, and that is understanding the investments you're putting in your money. Most of us, when you're going to start to invest, maybe you're investing because so and so told you, or because you saw it on the TV, you saw it on the internet. But it's always important that you dig further to understand the kind of companies you're investing in, or at least the kind of investment you're putting in money. Let me use an example. If you're investing in an index fund, it's always better that even you go further to understand where does this index fund invest the money. If you want to go for a specific stock, let me say if you want to buy Apple stock or MTN stock, Safaricom stock, it's always important that you dig further and understand these companies in details, because the last thing you want is a surprise which was so obvious at the time when you started your investment journey. So always make sure that you understand the business model of the companies you're investing in, because you have to be the expert literally in the company you're investing in. If you don't understand the investment, like Warren Buffett always refers to, if you don't understand the companies you're investing in, if you don't understand the model of those specific companies, it means that company or that investment is not fit for you. And then the third point is, and this is very important, always avoid falling in love with the companies you're investing in. Remember, why do we invest? It is a simple reason. We are investing because we want to get a return on that investment. In simple terms, you want to make money on the investment you're making. So if you fall in love with the company, it means you are highly likely to even not see the dark side of the company. You will not see when the company is making losses, or you will even not see when the company is sliding slowly but sure, because at the end of the day, you invested based on past performance because maybe the company was performing well. So if the company is no longer performing well, then it's about time you review and see, is it the best investment you should continue with, or you are far better off to sell off and then go into another investment. But if you are emotionally invested in the company, then those are things you literally, for lack of a better word, it's like you have a cloud on your eyes. You will not be capable to see some of the obvious things that are going on with that company. So always avoid being emotionally invested in the companies you invest in, because at the end of the day, you are investing for one specific purpose, and that is a return. And if the company is not giving you the better return, but there are better option or better other companies that are giving you the better return, you are far better to switch and leave company A to go and invest in company B, or to leave in one investment and take your money to another investment that is giving you a better return. Then number 4, always avoid being on the move from the investment point of view. If you have a higher turnover or a higher investment turnover, it's extremely dangerous, because this would imply that today you invest in company A, but it's like tomorrow you want to jump out and invest in company B. Then maybe still from company B, you want to invest, maybe to jump and then come back, invest in company A, or out of the blue, you want to jump off, invest in company Z. At the end of the day, as I said before, it's good to have a bit of patience, because the more you keep jumping in and out, there are costs you are incurring that you even don't have an idea. Because remember, every transaction, when it comes to investing, every transaction has a cost, but most likely you don't see that cost. Maybe it seems small, but along the way, those small costs can actually compound and become big costs, because every time you are investing in, every time you want to buy maybe new shares or whatever the case, there's a cost, remember, that you are incurring. So if you're jumping in and jumping out consistently, it means you're making a loss in 2 ways. The first one, you're incurring more costs, but the other one, you're missing on the return that would have come if you were a bit patient to wait and see how that investment will turn out. And number 5 is gambling. Avoid, if you want to succeed in investment or in investing, avoid gambling. And gambling, this is where most of the time people time the market. I don't know if you have heard about that term. When you time the market, it means you, in your mind, you think you have done your research and this is either the best time to get out or to get in that investment. But if that is the only way you think you're going to make money when it comes to investing, then you're highly likely doomed, because like gambling, you can never win the game. Always the house wins. It's like gambling, always the house wins. So in this case, at the end of the day, at some point, the market will time you out. So avoid timing the market and just continue to be consistent, but totally avoid as much as you can to time the market. And point number 6 is always avoid to wait to equalize. And by equalizing, I mean it's like in the football world. If the score is 2-1 and you want to score the second goal, be extremely careful if you want to practice the same in the investing world, because that would imply you are in a loss, but you want to remain in the market to recover back your losses. The more you wait, you are more likely to suffer in 2 ways. The first one is you're most likely to lose more money because the loss or the stock market can keep going down. So if you got out earlier, maybe you can count your losses and go and invest somewhere else. But because you have waited too long, the loss has gotten bigger and bigger. And the second way you can lose is what we call the opportunity cost. Because remember, if you had gotten out when you realized the investment is making losses, you would have used that money to go and invest somewhere, maybe in a better investment. But because you have stayed in for so long, you have lost the money here because you have made more losses, but also you have lost the money you would have made if you had withdrawn the money earlier on and invested it in the other investment. So always be careful from the football point of view. Sometimes you are 2-1 and you're waiting, and out of the blue, maybe it's 5-1. So at the end of the day, you always don't have guarantees that you always make back those losses. So if you feel like the losses are enough, you are better off to get out of the market, because the more you stay there, there's a possibility you lose more money, but also you're losing the opportunity to invest in another investment. And number 7 is always avoid putting all your eggs in one basket. In the economics world, that's what we call diversification. Always and always avoid putting all your eggs in one basket, because if anything happens to that basket, and by basket I mean if anything happens to that investment or that company, then it means you're doomed, because that's all what you had. Always be extremely careful. Always be extremely careful to invest only in one stock, or to invest only in one basket, or to invest only in one company. And the easiest way to do that is try to invest in different companies. For example, if you're interested in the stock market, if you invest in an index fund, you are far better off, because index funds invest in different companies, they diversify. So even if some companies lose, obviously other companies are gaining, and highly likely you rarely make a loss when it comes to index funds. But if you're going to independent stocks, then you are far better off to diversify and invest in different independent stocks. Because if you go with just one, if anything, if for example, you invested in Nvidia and something happened to it, it means you're doomed. But if you invested in Nvidia, Apple, Google, Microsoft, MTN, Safaricom, you have diversified your portfolio. You have diversified where you're putting your eggs, and it means if anything happens to one of the companies, you are extremely safe. But also, the other easier way when it comes to investment is to invest in different asset classes. For example, you can invest in business, that is in stocks, but on the other hand, you can invest in near cash items, for example, mutual funds, treasury bills and bonds, unit trusts, money market funds, or you can also invest in real estate. Now, highly unlikely that as time will come and you lose the real estate portfolio, you lose in your near cash assets, and you also lose in the stock market. That is highly unlikely. So that can be another better way to diversify your portfolio. And then finally, it is always and always avoid to be greedy, and also to use fear when investing. Fear and greed are one of the worst things that can ever happen to you, because when fear and greed are involved, it means you're working more with emotions and less with reality. But when it comes to investing, it's always good to use reality, because remember, investing involves figures. Numbers never lie. So why are you using emotions, and why are you using fear or greed? Because where there's greed, there's always a high risk, because greed is associated with you looking out for higher return. But with economics, the higher the return, the higher the risk. The lower the return, the lower the risk. So be very, very, very careful. And when it comes to fear, now fear, unfortunately, you might time out of the market when in reality you should have been patient to wait and see how that market or how that investment will perform. So always be careful when it comes to investment decision making. Do not use your emotions, because fear and greed are not your best friend when it comes to investing decisions. But now, if you have seen all these mistakes, how best can we avoid it? There are basically two ways I would recommend. The first one, if you can, is to seek a financial advisor. There is nothing better than having a financial advisor, but you need to be so careful when it comes to financial advisors. One, you need to make sure that you reason that the kind of person you're choosing or the kind of investment firm you're choosing to advise you in terms of risk, you are a little more or less the same, because you might choose an advisor who's so much risk averse, but when for you, your risk profile is quite different. So always watch out for advisors whom you can reason with on a similar wavelengths. But also, still on advisors, be always careful on their cost, because there must be value for the amount of information or advice you're getting from these advisors. So the cost should match the value. If the two are not matching, then better off not to choose that specific advisor. And then the second way to avoid all these mistakes is to give away the investing powers and leave a financial institution to invest on your behalf, because these financial institutions or these investment firms are already managing money for other people. So you will not be alone. But the good thing, honestly, they are professionally managed, but always just be careful on the cost that they're charging you to manage your money. But always also understand how they are managing it. Where do they invest the money? So for anyone out there who is scared or who's just starting their investment journey, please be careful of what I have mentioned. But as I already say, if you're a young person out there, the earlier you start your investment journey, the better, because that way the compounding effect will always work in your favor. And also the other thing is that when you start early, you allow yourself to make as many mistakes as possible, but also to learn from those mistakes. And along the way, you can always, on an early basis, choose the right businesses or the right investments that fit your investment strategy.